Want to invest in a business that is operating better than ever, more than 150 years into its history? Looking for a yield near 4% paired with a double-digit dividend growth rate? Like the idea of buying your shares on discount after the price has collapsed by 30%? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a major regional bank. Warren Buffett loves banks. I love banks. And maybe you should love banks too. Banks are literally in the business of money. That's partly why the business model has lasted for thousands of years. And that's partly why this bank is operating better than it ever has, even after more than 150 years of doing business. And yet, it's set up to continue growing its revenue, profit, and dividend for many years to come. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Fifth Third Bancorp, which appear to be trading at a significant discount today. Fifth Third Bancorp, stock ticker FITB, is a diversified regional bank holding company that offers a range of financial services and products such as deposits, lending, transaction processing, and advisory solutions. Founded in 1858, Fifth Third Bancorp is now a $23 billion by market cap banking powerhouse that employs 19,000 people. Headquartered in Cincinnati, Ohio, the bank is mostly focused on its core Midwestern market that includes the states of Ohio, Michigan, Illinois, and Indiana. With total assets of just over $210 billion, they are in the top 20 largest banks in the United States. To give that scale some context, there are over 5,000 commercial banks and saving institutions in the U.S. The bank operates four main businesses: commercial banking, 37% of fiscal year 2021 revenue, branch banking, 27%, consumer lending, 10%, and wealth and asset management, 9%. General corporate and other accounts for the remainder. There are two powerful pillars of the banking business model that makes it so attractive for long-term investors. First, endurance. There are few business models that have proved to be as enduring as banking. Banking dates back to antiquity. Why has it persisted for thousands of years? Well, our society basically cannot function without the proper flow of capital. That's particularly true for a free market economy like the US has now. Banks are integral to the flow of capital and the growth of a free market economy. The second pillar is the float. A float shows up in certain business models such as banks, insurance companies, and payroll processors. It's the low-cost capital that accrues as a natural course of doing business due to a time delay between capital being taken in and capital going out. Banks can and do take advantage of the float, earning a substantial amount of money on it while it's in their charge. Warren Buffett has repeatedly explained the genius of the float, using it himself through insurance operations to build a massive fortune. Beyond his own company's float, Buffett has invested heavily in other businesses that have a float, such as banks. If all of this weren't already attractive enough, many modern day banks have upped the ante by branching out into areas like wealth management, financial services, and payments. This further diversifies banks, all while giving them access to more capital and, more importantly, recurring fees. Recurring fees reduces the volatility of a bank's operating results by providing smooth income across the economic cycles. Put simply, modern-day banks have taken a wonderful and enduring business model and made it even more wonderful and enduring. This should translate into growth across Fifth Third's revenue, profit, and dividend for many years to come. As things stand, the bank has increased its dividend for 12 consecutive years. In fact, the bank just increased its dividend by 10% only weeks ago. Now, that raise does trail the 10-year dividend growth rate of 14.1%. Still, double-digit dividend growth is never anything to complain about. That's particularly true when you consider the stock's yield of 3.8%. This yield smokes the broader market's yield. It's also 70 basis points higher than its own 5-year average. And with a low payout ratio of 40%, we have what appears to be a well-covered dividend with plenty of cushion. I see nothing to dislike about the dividend metrics. You get a fairly high yield and a fairly high dividend growth rate protected by a low payout ratio. It's the best of all worlds. Looking at business growth, Fifth Third moved its revenue from $6.1 billion in fiscal year 2012 to $7.6 billion in fiscal year 2021. That's a compound annual growth rate of 2.5%. During a very challenging decade for banks, Fifth Third managed to put up respectable growth. Meantime, earnings per share grew from $1.66 to $3.73 over this period, which is a compound annual growth rate of 9.4%. That's a bit more like it. Really strong bottom line growth, profitability improvement, and prolific share buybacks both helped to spur excess bottom line growth. Regarding the buybacks, the outstanding share count is down by 25% over the last 10 years. Looking forward, CFRA is projecting that Fifth Third will compound its earnings per share at an annual rate of 4% over the next 3 years. This would represent a material slowdown in growth for the bank. I think some caution is warranted. There are fears that aggressive interest rate hikes from the U.S. Federal Reserve could drive the U.S. into a recession next year. It's even possible that the U.S. is in a recession right now. A recession hurts a bank on both the income statement and the balance sheet. It's a simultaneous decrease in loan demand and increase in loan losses. At the same time, however, CFRA's forecast does seem overly cautious to me. After all, the very same aggressive rate hikes that are designed to reduce economic activity are beneficial for banks. Indeed, Fifth Third's recent Q3 report for fiscal year 2022 showed sizable jumps in both NIM and NII. NIM came in at a remarkable 3.2%. Following the earnings release, CEO Tim Spence said this on CNBC, and I quote, "We've been around for about 164 years now, and we're having our best year ever in the history of the company," unquote. A lot of this comes down to the new rate regime, which is helping the bank to print some outstanding results. Also, it should be noted that Fifth Third has been rapidly expanding across Florida, one of the fastest growing states in the USA, which broadens and improves the bank's geographic footprint. In my view, it's tough to imagine a decade that's more challenging for banks than the last one, yet Fifth Third still grew its dividend at a double-digit rate. The bank is now operating and situated better than ever. I struggle to explain how or why the dividend should grow at a much slower pace over the next decade, even if the next year or two is tough. That would set investors up for at least high single-digit dividend growth from here. Pairing that with a near 4% yield is extremely compelling in my view. Moving over to the balance sheet, Fifth Third has a very good financial position. They have total assets of $206.3 billion against $183.5 billion in total liabilities. The bank sports the following investment-grade credit ratings for their senior debt: BBB+ S&P, Baa1 Moody's, and A- Fitch. Profitability is robust. Over the last 5 years, the firm has averaged annual net margin of 31.4% and annual return on equity of 12.2%. Net interest margin, NIM, came in at 2.6% for fiscal year 2021. Fifth Third is running a great operation here, and with economies of scale, a large float, switching costs, and built-up relationships, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. In particular, regulation is a constant thorn for any bank. The U.S. Federal Reserve has been aggressively increasing interest rates, but rates are actually still low by historical standards. The company has substantial exposure to economic cycles, and the current cycle is unusually uncertain and concerning. Recessionary risks loom, and a recession can hurt a bank in two ways. Less economic activity reduces growth from deposits and loan demand, while loan losses harm the balance sheet. While these risks are worth carefully thinking over, I believe the bank's overall quality outweighs the risks. And with the stock's price down 30% from its 52-week high, the valuation really tilts the scales in favor of the long-term investor. The price-earnings ratio is 10.9. We're nearly at a single-digit PE ratio here. This is well off of the market's earnings multiple, which itself has become quite compressed. That said, this is pretty much right in line with its own 5-year average. The price-to-book ratio of 1.6 is right about what I'd expect, since most banks oscillate in a range of between 1 and 2 times book. But the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis that factored in a 10% discount rate and a long-term dividend growth rate of 7%. This high single-digit dividend growth threshold strikes a balance. It's measurably lower than what the bank has been able to compound its earnings per share and dividend at over the last decade, and with higher rates and a modest payout ratio, a severe reduction in dividend growth seems unlikely. On the other hand, CFRA's near-term earnings per share growth forecast is much lower than this mark, and also recessionary risks are higher than they've been in some time. Putting it all together, I see the bank as highly capable of producing at least high single-digit dividend growth. It's possible they exceed this expectation, but I'd rather err on the side of caution. The dividend discount model analysis gives me a fair value of $47.08. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Fifth Third as a 4-star stock with a fair value estimate of $45. CFRA rates Fifth Third as a 3-star hold with a 12-month target price of $33. I came out slightly high, but CFRA's number strikes me as too pessimistic. Averaging the 3 numbers out gives us a final valuation of $41.69, which would indicate the stock is possibly 17% undervalued. Here's the bottom line, guys. Fifth Third Bancorp is a high-quality regional bank that has performed admirably during a tough decade. The company is operating and positioned better than ever, which means the next decade could be even better. With a market-beating yield, double-digit dividend growth, a moderate payout ratio, and the potential that shares are 17% undervalued, a long-term dividend growth investor would be wise to consider depositing shares of this bank into their portfolio. And now for a special news announcement. Essex Property Trust Inc., stock ticker ESS, just printed a great Q3 report, easily beating on the bottom line. They also raised guidance. Gotta love a beat and a guidance raise. Oh, and scheduled rents rose by 8.9% year over year. We already shot a video highlighting what a great long-term investment Essex Property Trust has been and continues to be. This video also shows why this business looks extremely undervalued. The video should go live soon if it hasn't already. Either way, keep this high-quality multifamily property REIT on your mind. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.